Fed's scary warning: financial conditions will leave you shocked. All is not well with the US economy, and this has been confirmed by Jerome Powell. In an interview, he said that the prevailing financial situation in the US will get worse after the collapse of the Silicon Valley Bank. The collapse of the bank could potentially slow down the economy. The reported decline in the financial system will be significantly lower than what the financial indexes have reported so far. How badly will the US economic system be hit, and how? Stay tuned to find out. But before we go any further, I would like to request that you subscribe to our channel. Thank you. The Federal Reserve is pretty sure that the economy is headed towards a recession. There is an impending credit crunch that is going to be even worse than the financial meltdown of 2008. One indication is that interest rates have taken a hike of almost 25 basis points, which may mean that in the short term, interest rates could go up to 4.9%. This would be the highest it's been before the financial crisis of 2008. So, the last time we had an interest rate that was near 5% was right before the financial crisis. We are already seeing the economic recession shock the job market, with layoff announcements increasing in frequency every day. Data from big employers is already pointing to a very gloomy scenario. Amazon said that it will cut 9,000 jobs. Furthermore, Indeed is laying off almost 2,200 employees. Indeed is the same website that provides job listings, through which people look for jobs. This means that if job search websites are cutting down on their workforce, then the overall trend of the job market must be very bad. The CEO of Indeed has said that the job openings in the last quarter went down by 3.5% as compared on a year-to-year basis. This means that companies are paying nearly 33% less to Indeed to promote their jobs. Now, the huge slash in Indeed's workforce makes much more sense, doesn't it? But there were also rumors about these tech layoffs happening just around the corner. This would mean that economic downturns are not that bad, since they are limited to specific industries and market sectors. The general perception is that this economic recession is not going to be particularly bad, nothing that we haven't weathered before. But one thing about indicators of economic recession is that they are mostly lagging. The effect of these layoffs compounds over time. This means that initially, it seems that unemployment is hitting only specific job markets, such as tech industry. But soon, these layoffs will quickly compound into unemployment for white-collar workers. This reduces overall consumer spending and slows the economy. The fear is that when these waves of unemployment hit the public consciousness, the system will already have crumbled, with inflation already soaring and the general economic indicators stagnating. When you factor in layoffs, people's capacity to purchase basic life essentials would be severely compromised. This would result in people being unable to pay their bills. Now, the indicators do not exactly paint the doomsday scenario that I'm explaining, but a close observation of the job market would be enough evidence. Just browse through Indeed.com and you will see what I'm talking about. You will see that the variety of job offerings has been severely limited. Full-time jobs are listed at about $20 to $25 an hour. Now the next thing you need to do is look for a decent bedroom. Let's look at Atlanta on Zillow, for instance. A good apartment will cost you around $1,800 per month. If you want to rent a house, then you are looking at $2,500 per month. The question is, will you be able to afford this house on a job that pays $25 an hour, even if you work full-time? The numbers do not add up. If you're looking to buy a house in this economy, then the mortgage interest payments will be more brutal. You will be looking to pay somewhere between $3,000 and $3,500 if you were looking to buy a house in any metropolitan city in the US, and obviously for the big cities like NYC, the mortgage payments would be completely insane. So the question is, if everything is fine and dandy with the economy, then how is the average American working 40 hours per week going to afford these skyrocketing rents and mortgage payments? Of course, the real estate market will twist this picture and try to argue that if things are this bad, then why are people buying more homes than before? To be clear, this isn't exactly untrue. What this means is that the indicator that tells us about the performance of the real estate market is also lagged, like other economic indicators. The figure of a 15% increase in total home sales is not exaggerated, but it is outdated. Things have drastically changed between then and now. In fact, if you look at the mortgage applications filed for these home sales, they are going down, which either means that people can now afford to buy their homes without paying for a mortgage, or that fewer people are actually buying homes. The answer is that fewer people are actually buying homes than before because mortgage interest rates have gone up to 6.5%, which greatly exaggerates the overall value of the commodity they are buying. Other indicators support this argument. For example, in California, where home sales were between 30 and 40% year over year and have now dropped to 23%. The home sales stats were down in metro cities like San Diego, Sacramento, and San Francisco anywhere from 30 to 40%. Let's conclude by revisiting the tech sector. In California, most people usually work in either the media or the tech industries. The market placement stats show that there are either big booms or big busts in California, and it just so happens that we are seeing the start of a bust. The severity of this bust is expected to last for the next 5 years. Now, you see, everything is connected. From tech job layoffs to the decline in home sales to the decline in mortgage applications. When you put together all these economic factors, you can see that the US economy is headed towards a recession. Comment below about your thoughts and if you agree with what we have discussed in this video. Thank you for watching this video to the end. Please give this video a big thumbs up. See you in the next one.